Most investors spend their entire lives trying to time the market. They chase hot stocks. They panic when crashes come. They celebrate when markets rally. But here's the truth the wealthy already know. Timing doesn't build wealth. Allocation does. Studies prove this. Over 90% of portfolio returns come from asset allocation, not individual stock picking. Yet, most investors spend 90% of their energy picking stocks and almost none on allocation. The wealthy do the opposite. They engineer portfolios that can breathe with the cycle, expanding, contracting, adapting. This video is your blueprint. You'll learn how to allocate across equities, bonds, real estate, gold, and alternatives, not randomly, but with intention, the way the rich do it. Class begins. Let's start with a hard fact. Most investors think success depends on finding the right stock, but research says otherwise. In 1986, a landmark study by Brinson, Hood, and Biebauer analyzed thousands of portfolios. Their finding? 93% of portfolio performance came from asset allocation decisions. Only a tiny fraction came from timing or stock selection. Think about that. Whether you pick Apple or Microsoft matters less than how much of your money sits in equities versus bonds versus real estate versus gold. Example, two investors. Investor A, brilliant stock picker, but 100% in equities. In 2008, their portfolio collapsed by nearly 50%. It took years to recover. Investor B, average stock picker, but diversified 50% equities, 30% bonds, 15% real estate, 5% gold. In 2008, losses were contained. Bonds and gold cushioned the fall. Recovery came faster, and compounding continued. Who was smarter? Not the one with the perfect stock, the one with the right allocation. So here's the first lesson of the blueprint. Allocation greater than stock picking. It doesn't matter how good you are at picking winners if your overall allocation exposes you to ruin. In Chapter 2, we'll explore the market cycles, expansion, peak, recession, recovery, and how each asset class behaves in these seasons. Because once you understand the rhythm of cycles, you'll see why the rich allocate differently at different times. If allocation is the foundation, then cycles are the weather patterns that test it. Because assets don't move in isolation. They move in cycles. And if you don't understand these cycles, you'll always feel like investing is chaos. But if you do, you'll see the rhythm. The 4 phases of a market cycle. Every economy and every market dances through 4 repeating stages. 1. Expansion, growth, optimism, jobs rising, stocks thrive, real estate picks up, commodities rise with demand, bonds weaken as interest rates climb. 2. Peak, growth overheats, inflation builds, central banks raise interest rates, commodities, especially oil and metals, often spike, stocks wobble, they sense exhaustion. 3. Contraction, recession, demand falls, jobs cut, fear spreads, stocks crash, real estate slows, bonds rise, the safe haven, gold rallies, the crisis hedge. 4. Recovery, rates are cut, spending revives, stocks rebound first, real estate lags but catches up, commodities stabilize, historical proof fails, 2000 dot-com bust, tech equities collapsed, but gold and bonds stabilized portfolios, 2008, global financial crisis, real estate and stocks sank, but US Treasuries and gold surged. 2020, pandemic crash, stocks fell 30% in a month, but gold hit record highs and bonds absorbed panic. The wealthy don't see these as surprises. They see them as patterns, seasons that repeat. The rich don't panic when cycles shift. They don't dump everything in fear. They rotate. Expansion, overweight equities. Peak, tilt into commodities and real estate. Recession, bonds and gold dominate. Recovery, shift back to equities, alternatives. This is how their portfolios breathe with the cycle instead of breaking. So here's the truth. Market cycles are not enemies. They are seasons. The rich build portfolios that adapt. In Chapter 3, we'll dive into the allocation frameworks the wealthy actually use, from the classic 60/40ths to the all-weather portfolio and the barbell strategy. Now that you understand market cycles, the next step is knowing how the wealthy engineer portfolios. Let's break down the most powerful ones. Framework 1. The classic 60/40ths portfolio. For decades, the simplest and most reliable model has been 60% equities, growth engine, 40% bonds, stability and income. Why it worked? Stocks delivered growth during expansions. Bonds cushioned crashes. Example, in 2008, stocks collapsed 50%, but bonds soared, keeping losses manageable. Weakness. Struggled in 2022's inflation spike, when both stocks and bonds fell. Framework 2. The all-weather portfolio. Ray Dalio. Built to survive any season. 30% equities, growth. 40% bonds, defense. 15% commodities, ESPN's gold. Inflation hedge. 15% diversifiers. Inflation-protected bonds, alternatives, backtests. Rarely the best performer, but almost never the worst. It's like a fortress, steady, balanced, resilient. Framework 3. The barbell strategy. Nassim Taleb. A barbell has weights at both extremes, applied to investing. 80–90% in ultra-safe assets, cash, bonds, gold. 10–20% in ultra-risky bets, crypto, startups, growth stocks. Example, if crypto explodes, that 10% could transform into 30–40% of your net worth. Framework 4. The core satellite approach. Think of it like Earth and its moons. Core, 70–80%, equals stable, diversified base. Satellite, 20–30%, equals high-conviction plays. Modern investors love this because it blends discipline with flexibility. Framework 5. Family office. Allocation. Ultra-wealthy families, managing billions, often use 20–30% equities, 20–30% real estate, 20% bonds and fixed income, 10% gold and cash. Their goal isn't just growth, it's legacy, so here's the truth. The wealthy don't chase the one right stock. They build portfolios. In Chapter 4, we'll personalize it, showing how allocation changes by age and risk profile so you can tailor your blueprint to your own life. So far, we've studied allocation frameworks, but here's the truth. There is no one-size-fits-all. Your allocation should depend on who you are, how old you are, and what risks you can bear. Let's break it down. The young investor, 20s to early 30s. You have time, decades ahead. Your greatest asset isn't money. It's time horizon. That means you can take more risks now. Sample allocation, educational only. 70–80% equities, global plus domestic index funds. 5–10% bonds. Fixed income for stability. Small exposure to gold/real estate. Why? Because even if markets crash, you have 20–30 years to recover and compound. The midlife investor, late 30s to 50s. You're balancing career, family, and retirement planning. You can't afford reckless risk, but you still need growth. Sample allocation, 50–60% equities, 20–25% real estate, including REITs, 10–15% bonds, fixed income, 5–10% gold, insurance, 5% alternatives, only if you have conviction. This stage is about balance, growth plus safety. The pre-retiree/retiree, 55+. Your priority is preservation and income. You can't risk losing half your portfolio in a crash. Sample allocation, 30–40% equities, defensive sectors, dividend stocks, ETFs, 30% bonds, fixed income, predictable cash flow, 20% real estate, rental yields or REITs, 15%. Gold, beyond age, risk personality. It's not just about age, it's about psychology. Aggressive investors, comfortable with volatility, long horizons, higher equity and alternatives. Balanced investors, mix of safety and growth, blend of equities, bonds, real estate. Closing Chapter 4. So here's the truth. Allocation is personal. A 25-year-old engineer in Bangalore should not mirror a 60-year-old retiree in New York. In Chapter 5, we'll turn this into a step-by-step action plan, how to start building and rebalancing your allocation today. Now it's time to get tactical. Not theory, not models, but a clear action plan you can start today. Here's the 5-step process the wealthy follow to engineer allocations that work. Step 1. Audit your current portfolio. Before you add or change anything, map what you already own. Write down percent in equities, bonds, real estate, gold, alternatives. Most people discover they're over 80–90% in one asset class, usually equities or property. Awareness is the first correction. Step 2. Define your goal and timeline. Ask yourself, what am I investing for? Retirement, house, wealth freedom? How long is my horizon? 5, 10, 30 years? Your allocation should reflect your destination. Step 3. Create your allocation mix based on your age, risk profile, and goals. Sample starter, blueprint, educational only. 50% equities, ETFs, index funds, global exposure. 20% real estate, direct or REITs. 15% bonds, fixed income. 10% commodities, gold, silver. It's not about perfection, it's about balance. Step 4. Rebalance annually. Markets move, your allocation drifts. If equities boom from 50%, 70%, trim and shift to bonds or gold. If commodities crash, buy a little more at low prices. Step 5. Automate and stay consistent. Automate monthly investments, SIPs, DCA into ETFs, REIT contributions. Remove emotion from the process. Trust compounding. Quiet millionaires don't check portfolios daily. They automate, review annually, and let time do the work. So, here's the blueprint in action. 1. Audit. 2. Define goals. 3. Allocate. 4. Rebalance. 5. Automate. In Chapter 6, the final chapter, we'll put this blueprint to the test with real-world examples, showing how diversified portfolios survived crises like 2008 and 2020, while concentrated ones collapsed. Theory is powerful, but what makes it real is history. So let's test this blueprint against the storms of the past. The 2008 global financial crisis. Concentrated investor, 100% stocks. Portfolio down tilde 50%. Many panicked, sold at the bottom, and never recovered fully. Diversified investor, 60% stocks, 30% bonds, 10% gold. Portfolio down approximately 20–25%. Painful, yes, but survivable. Within 2 years, recovery was complete. Lesson: allocation cushioned the blow. The 2020 pandemic crash. Concentrated investor, travel and airline stocks, down 60–70%. Many companies went bankrupt. Balanced investor, equities plus bonds plus gold. Equities dropped, but bonds surged, gold spiked. The portfolio recovered in months, not years. Lesson: allocation provided resilience. The wealthy's advantage. This is why wealthy families don't fear recessions. They design portfolios like fortresses. If one door collapses, another stands. If one asset bleeds, another heals. If one sector slows, another accelerates. So here's your challenge. Don't just watch this blueprint. Apply it. Audit your portfolio today. See where you're overexposed. Start building balance. Because wealth isn't built in bull markets. It's tested in crashes. And only diversified portfolios survive long enough to compound into freedom. Here's what to do next. Subscribe. I'm building a free library of masterclasses on asset allocation, equities, real estate, and global investing. Comment. Tell me, which asset class do you want me to break down in detail next? Share. Send this to someone who still believes diversification is owning 10 stocks. Because quiet, well-diversified wealth doesn't just survive, it endures.